Hello and welcome to another financial analysis video. And in this video, I am going to be looking at SpaceX. Now, hopefully, most of you have heard of SpaceX, but for those of you who have been living under a rock, it is, of course, the space exploration company that is about to be launched by or IPO'd by Elon Musk. So today, I'm recording this on the 3rd of June and the IPO date is scheduled for the 12th of June, so in 11 days' time. And what I'm going to do is I'm going to take you through the registration statement. So this is from Form S1. You can find this online, and I just wanted to highlight some of the key numbers that you might find of interest. Now, a lot of information in this, a lot of pretty pictures, a lot of sort of highlights and great, wonderful work of what's been going on. But what I want to sort of do is try and cut through all of that and really look at the financial statements. So SpaceX, Space Exploration Technologies Corporation, doing business as SpaceX, is a private American spaceflight, telecommunications and artificial intelligence company headquartered at the Starbase development site in Starbase, Texas. Now, a few important things to notice in that it is three different businesses and it is based in Texas. So this is from the IPO brochure, and the three businesses are the SpaceX, which is the kind of space technology and human flight and putting people onto Mars and beyond and all that kind of stuff, all that sort of really sexy stuff. Also Starlink, many of you will have heard of Starlink. So this kind of this low latency broadband internet around the world. You can sort of set up your Starlink and then bounce off satellites, so you don't have to plug in or wait for a mobile phone signal. And finally, we've got Twitter in there, obviously known as X now. So X, formerly known as Twitter, and the kind of the AI or XAI, as it's known, in there as well. So these are the three main elements. And as I mentioned, it is based in Texas, and we'll come back to that in a little bit later on. So here are the financial statements, and the first thing we're looking at is the income statement. This is the revenue. The income statement shows the profit and loss of the organization. The revenue, it's turning over about $18.7 billion. So you can see, fairly good growth from 10 billion, 14 billion to 18 billion. And we're actually provided with a breakdown of those numbers. So the actual SpaceX part is about 4 billion. So this is kind of putting satellites into space and associated services. Then we've got the actual connectivity. So that's really where the money's coming from at the moment. So 11.4 billion coming from Starlink, etc. And then finally, we've got XAI or the and the Twitter or X as it is with a little bit of revenue. So some advertising revenue coming in there and some bit of AI solutions and infrastructure, about 3 billion. So really, most of the historical revenue has been coming from the connectivity side, so from that Starlink. And you may also be interested to know that one particular customer accounts for over 20% of the revenue. It doesn't mention who that customer is, but we can probably guess that it is probably the United States government. So a lot of the revenue is dependent on maintaining goodwill and those relationships with the US government and the current US administration. So getting back to our income statement, revenue about 18, nearly 19 billion. The cost of revenue, the cost of sales is about 9 billion, leaving them with that's about a sort of 50%, isn't it? So it's a 50% gross margin, and then a very significant expenditure on the R&D, which leads us to a loss. Now, without the R&D, it's underlying it's a profitable business. Now obviously this is a play on the future, and so this is going to be a very significant part of the costs going forward. So the SG&A, the cost of running the business, relatively low. So without that R&D, it is profitable, so underlying profitability, but obviously with the R&D, it is making a significant loss. There's some interest payable, which means it's going to have debt. When we look at the balance sheet, we'll see some debt. And so overall, this is a loss-making business. Okay, so loss-making business operating at a loss, but at least it's trading at a profit. So it is trading at a profit, and it's EBITDA. It is EBITDA positive as well. So the EBITDA margin, I think, is round about 22%, something like that. So it is definitely profitable. Yeah, 22% EBITDA margin. So it is a kind of core profitability business, but obviously you're buying the kind of the future potential of this and its ability to expand. So there's our bottom line. 5 billion of loss. Looking at the balance sheet, so a few interesting things about the balance sheet. So looking at the assets and the liabilities. So the assets, first of all, you notice they have a lot of cash. Okay, a lot of cash since the previous year. They've actually raised lots of money. So because they are, they're loss making, they're not generating their own cash. So they've gone to the market and raised cash. We'll see that in a minute. So they've got about 25 billion of cash, and they've also used a lot of the cash that they've raised to buy property, plant, and equipment. So you can see that that's gone up by about 20 billion. What's also interesting, sitting on the balance sheet, relatively, not massive numbers, but the digital assets and the goodwill I thought was quite interesting. First of all, the digital assets is Bitcoin. So this company owns about 1.6 billion of Bitcoin. Don't forget, Bitcoin is a fairly volatile currency at the moment. So it's not going to, if it goes to zero, it's not going to affect the company. But just to be aware that, that is sitting on the balance sheet. And also the goodwill. So don't forget the goodwill. So goodwill arises when a company buys another company and it pays more than the fair value of the net asset. So if you buy a company, you're buying all the assets, tables and chairs, property, plant and equipment, and you also buy the liabilities, what you owe to suppliers and the debt, for example. And the difference between those is known as the net asset value, also known as the book value. But when you buy a company, you tend to pay more than that because you're buying the brand and the reputation and the future income and the potential, etc., etc. So the difference between what you pay for a company and the fair value of the net assets is known as goodwill. And you'll notice here that they have about 11, pretty much 12 billion of goodwill, and most of that is attributable to the AI segment. So the AI segment, you remember, this is Twitter and X. And so in effect, SpaceX as a company owned by Elon Musk then bought the connectivity, so Starlink, and bought Twitter. And on that kind of consolidation, this goodwill has arisen. So this is effectively Elon Musk buying his own companies from himself and creating this goodwill, which now sits in the balance sheet. Remember, you can't put goodwill on eBay and sell it, so it doesn't really have any sort of actual value. It's just an accounting value. Down the bottom, we see the liabilities. Now, just looking at the liabilities, the current liabilities, things we have to pay quite soon. We often like to kind of compare that to the current assets. Liquidity isn't a problem for these guys. They've got lots of cash. So really, these guys they're not going to run out of cash too soon. And if the IPO goes to plan, then they're going to raise a whole lot more cash. And so, that kind of, that cash flow is going to be less of an issue. It's more about whether they have a sustained business model. And you'll also notice on the balance sheet, they have a reasonable amount of debt. Again, that debt has increased from 13 to 21 billion or 22 billion. So they've raised money both through issuing shares and through borrowing extra amounts of money. And that debt is why they're paying the interest on the balance sheet. Now, typically, the interest cover, the operating profit versus the interest is a concern because they're making an operating loss. But these guys, they've got the cash. They've raised lots of cash, so it's not an immediate concern to us right now. So that debt, just so we understand the debt, it looks like it's a kind of there's a degree of hangover from the various individual businesses, and also that they have raised additional amounts in the last year. And we'll see that in the cash flow statement. And in terms of maturity, it's always worth just checking out when is it all going to be repayable. And it suggests that most of it is going to be repayable in 2027. So there's going to be a big sort of refinancing exercise going on in 2027 to either refinance the debt or repay the debt with the money raised in the IPO. And the bottom of the balance sheet, so this is where we see the equity. Now, the equity is actually relatively small, about 2.5, 2.6 billion. The reason for that is that 2.5 or 2.6 billion doesn't include the redeemable convertible preferred stock. So this is a kind of hybrid type of equity. So you can, if you're raising money, you can either go to the shareholders and raise money through equity, which is where you sell shares in the business. That's this 37 billion. Or you can go to the banks and you can borrow money, which is the 22 billion. What we've got here is redeemable convertible preferred stock. And there's a little bit of a explanation in the brochure about how, if you own this preferred stock, effectively you're able to convert into Class A shares. So it's a form of a hybrid type of financing. And there's an argument that says we should include it within the long-term liabilities, and there's another argument that says we should include it within the equity. Without it, the equity is very, very small, only 2.6 billion. So at the total balance sheet of 92 billion, only 2.5 is actually the ordinary shareholders. And when we look at those numbers, we can see that in effect, what they've done, what this company has done, is that they've raised 38 billion. That's the 37,706, and they've lost it. They've spent it on running the business and rockets that don't work, and all that kind of stuff, etc., etc. So effectively, all of the money, the ordinary shareholders' capital that they've raised, they've lost. They've then raised additional capital through this preferred stock and through the debt as well to fund the business. So in the movement in equity, this is reflected in the movement in equity. We can see that the company has been making losses. It's been making losses for the past few years, and that's why we have an accumulated deficit of 37 billion. And each year it has been raising additional amount of capital. And then we also notice that they have been raising money by issuing these convertible preferred stocks. So that's what they've been doing sort of previously, issuing those, rather than issuing shares, they issue stock which can be converted into shares. So the cash flow statement, yes, they're making a profit, making a loss, but they are generating cash. So the main reason that they are making a loss is because of that depreciation amortization. So we can see the 6.7 billion of depreciation amortization, which is it's a non-cash expense. So yes, they're making a 5 billion loss, but they are actually generating about 6.8 billion in cash, and the main reason is that depreciation and amortization. Now, depreciation and amortization is a reflection of the fact that they have lots of assets, and they have lots of assets because they've been growing the business and buying spaceships and satellites and all this kind of stuff, etc., etc. And then what are they doing with that cash? Well, they're investing very, very heavily. So as we saw, their property, plant and equipment had increased by about 20 billion. So we can see that very clearly in the cash flow statement. They've spent 21 billion, increasing the size of their asset base. And if you're generating about 6.8 billion and you're spending 20 billion, you're going to have a shortfall. And so the last part of the cash flow statement tells me how they are making up that shortfall. So in effect, they are issuing debt. They're borrowing money. They're using a little bit of that to repay debt. So this is the refinancing, but 10 billion is an increase in the debt. And they are doing that issuing of the capital stock. You remember the preferred shares that we saw in the movement in equity and we saw in the balance sheet. So this is a company which has been raising money over the last, it's been growing, it's been losing money, and it's been going back to the investors, to the banks, to the shareholders, and raising additional amounts of money. And now that they are doing this IPO, they're looking to raise significantly more amount of money through this IPO in order to give them the cash base to be able to continue with their growth story. I mentioned that they are based in Texas and that they are issuing Class A common stock. It's worth noting that they were, the SpaceX was originally incorporated in Delaware. It's moved to Texas. That's where their their base is, but also the laws around shareholder rights are much tighter in Delaware and much looser in Texas. Now, I'm not a lawyer and I couldn't tell you the exact detail of that, but certainly my understanding is that you can do a lot more as an owner. So, for example, some of Elon Musk's share options on Tesla, for example, Delaware courts in Delaware weren't very happy with them when he was, awarded, massive stock options. So by relisting in Texas, they're much more relaxed and say, yeah, you can go ahead and do that. Don't forget, you're buying A-class shares. This is some of Elon Musk's shareholding. So he's got about 849 million. So that's nearly a billion A-class shares. But then if you look at his B-class shares, he's got over 5.5 billion of B-class shares. And it's worth bearing in mind that if you own an A-class share, you get 1 vote per share. And if you have a B-class, then you get 10 votes per share. So while you may be buying a share in the business, Elon Musk will very clearly retain ownership. He will have the voting rights for the entire company, and he can effectively do whatever he wants. And there's pretty much nothing that you as a shareholder can do with it, as a combination of A, you don't have any voting rights, and B, the company is not listed in Delaware, it's listed in Texas. So rumor has it we're looking at about a 1.8 billion market value, and if you take the net asset value, now in this net asset value I've included the convertible common stock. If you exclude that, it's an even smaller number, but basically it's all goodwill. So you're not buying the company, you're not buying the future income, you're really buying the brand and the potential and the opportunity, and this kind of, is it going to deliver on its promises? 100 times sales. Now, maybe, we are going to the moon. Maybe it's going to colonize Mars. Maybe everybody's going to give it all the money that it wants, etc., etc. And this is the future. But it's quite a punchy valuation, and quite interesting looking at how Elon Musk is looking at raising a lot of this money from retail investors as well as institutional investors, suggesting that he's really looking to tap as much of the market as he possibly can. And don't forget, a lot of the people who've got those shares, they will be locked up, but at some point in the future they'll be looking to kind of realize those shares as they become vested. So is it a great opportunity? That's not for me to say. That's entirely up to you as to whether you invest. But I think it's certainly very highly valued. But then we've seen Tesla trading on 1,000 times earnings, and still people have made money. So maybe SpaceX and Elon Musk will continue to defy gravity. So I hope you found that useful and interesting. Please do leave any comments in the comments box. Remember to be polite. It doesn't cost anything to be polite, and I'm sure that you'll provide some additional information, point out where I got things wrong, or maybe I've missed something, or want to add your own own story to this remarkable IPO.